Hey everybody, how are you doing today? I hope your Monday is off to a great start. And I wanted just to give a couple updates on a few changes here in the mortgage market. I would have assumed a lot of people had already known that the loan amounts for the conforming loans have changed, but after talking to a lot of people, they really did not know. So I wanted to give a quick update on what has changed with those loan amounts. So the conventional loans have changed, and actually it's better. Coming into this year, they've gone up to 484,350. So what that means is, before you are into a jumbo loan, you can get a conforming loan limit up to that level. Anything over that would be considered a jumbo loan. So let's see here. So I just want to talk about that a little bit, and if you guys have any questions about the new loan limits and how that would affect your current loan in process, or maybe a refinance or something like that, let me know and make a comment below. You guys are more than welcome to interact with me here and ask questions, and we can talk about some different things. Also, I wanted to talk to you guys a little bit about our loan process and our pre-approval process. So we as a company have kind of changed the rules a little bit on how the loan pre-approval process goes. Traditionally, the loan pre-approval process would be a customer would come in, they would get a pre-approval by sending in some information, maybe pulling credit, running a DU or a desktop underwriter on that and getting an approval, and then kind of waiting until they find a property and then submitting the loan to underwriting once they get an appraisal back, and then you can do it that way, but sometimes you kind of run into some issues with maybe an income issue or a credit issue, or a job stability issue, or something that maybe wasn't initially detected. And I've been in that situation before, and finding out a loan does not get approved because of one of those reasons, 2-3 weeks in the transaction, is very challenging for us, for the borrower, for the referral partner, for the listing agent, sellers, everybody. So what we've done is we've kind of changed the rules on how we handle our pre-approvals and loan process. So what we do, we have an actual program called the Almost Home program. So what we do is we basically talk with the borrower up front. We gather all of their income docs, assets. We verify their job. We basically send them through underwriting up front and get them all cleared as if they were cleared to close without a property. So what we've done is we've taken away all of the issues that may come up with regard to income, credit issues, any stability, with the job or housing or anything like that could put a problem within a file, could throw a wrench into it late in the transaction if you do it the old traditional way. So if you're a buying agent or even a listing agent that's working with any buyers that want to do it the right way, to make sure that when you put in a contract, your buyer is treated as if they were a cash buyer, because we can close in as little as 15 days. And we actually have a closing guarantee on that. So if they follow our process through our Almost Home process, we will actually take them through and get them done through our process. So when they go out into the street, you can actually write a contract and actually close that that borrower in as little as 15 days. All you would need is the inspection, appraisal, title. And as long as all those things come into play, we could actually go ahead and get them closed very quickly. So it puts you as a buyer's agent in a situation where you can negotiate maybe a better price, or because you definitely can negotiate a better time frame than maybe other offers that come in. So if it's a multiple offer type of a situation, then you'll be able to be aggressive with your offer and get more sellers to agree more quickly, because we can close more quickly, because we close most of our loans, probably 90% of them or more, in-house. We have our own processors, underwriters, closers, funders. We close everything in our own name. We are a direct lender, direct with Fannie, Freddie Mac. So we are, we can handle everything in-house. That's why we can do it so fast. We do have some specialty loans that I mentioned on a prior video of mine before, which we call the non-QM type loans, which we can do bank statement loans, no ratio loans for self-employed people for the bank statement loans, and no ratio loans for like investors, or I've done a bunch of them for real estate agents that, or if you have a good income, but you write a lot of your income off, then one of those two types of loans may work for you. The no ratio loan is kind of cool, because as long as the property debt service itself, then that's all we need to do. So there's no income on the application. There's assets to close. So it's a really awesome program for that particular type of person, and outside the normal Fannie Mae, Freddie Mac guidelines and stuff, through our non-QM lenders, we can do people that have, credit issues, low credit scores, bankruptcies, foreclosures, or certain instances that would kick them out of a normal Fannie, Freddie Mac type of a loan, or an FHA or something like that. So just wanted to kind of throw that in there. I did a video on that not too long ago that they kind of talked a little bit about our non-QM products. So if you have questions about those, put a comment in, or private message me, or ask me any of those questions. I'd be more than happy to talk with you more about that. I also wanted to talk about another program that we have that that's really good for first-time home buyers. So in our world, a first-time home buyer is somebody that has not owned a home in the past 3 years. Okay, so if you had owned a home in the past, and if you've owned many homes in the past, but not in the last 3 years, you're actually considered a first-time home buyer. So what happens then is we have a program called the Mortgage Tax Certificate Program. So that'll actually give you, there are some income limitations and stuff like that on the program, and purchase price limitations. So if you're somebody that possibly would consider qualifying for that program, I can run some numbers in some situations and see what you get. But the cool thing about that program is it gives you up to a $2,000 a year income tax credit. So it's based on your income tax. So as long as you've paid, there's a calculation involved with it, but if you've paid that much in your interest on your mortgage, a percentage of that will actually, based on your income, will come off your income tax, personal income that you pay the IRS. So if you owed a $5,000 income tax bill, or over the years, then you would actually only owe $3,000, to be simple about it. But there's a little bit more calculations that are involved with it. So if you have more questions about that, make some comments, or private message me below or offline, and I can go into a little bit more details about it and just kind of give you the real lowdown of those calculations and stuff. So we did talk about the 15-day closing guarantee. So I'll talk a little bit about that one more time. So if you follow our procedure for the pre-approvals, and you get pre-approved up front through our process, we call that the almost home process, we can close you as little as 15 days. So just wanted to touch base on that again. So, everyone always asks me, are you a Fannie Mae? Fannie Mae is really the more common known lender out there, but we're both Fannie Mae and Freddie Mac lenders. So there are some differences between them, and honestly, I don't know them at the top of my head all the time, but I'm pretty familiar with a lot of them. So I'm going to kind of look down some notes I put that highlights a couple of the differences between the two. Over time, they change a little bit, So in most cases, so we have the purchase loan to values and cash out loan to values and stuff like that are pretty much the same between those two programs. So those are pretty standard stuff. Now, some differences come into play when you are when it comes to like credit and liabilities. Fannie Mae has a debt to income ratio that's maxed out at like a 50% debt to income ratio, whereas Freddie Mac actually doesn't even publish one. but you have to get an approval and accept under their system, under the Freddie Mac loan prospector platform. And another interesting thing is, Fannie Mae, has a DTI calculation that they use, and it's okay up to about 2 decimal places, and it goes off the real actual DTI calculation, whereas Freddie Mac actually rounds down. So if you have a back end DTI of 49.9 or 40, I'm sorry, like 20.49 will go down to 20, and if it goes up over, if it's over 20.5, then it's over. So and Fannie Mae has a minimum credit score of 620, whereas Freddie Mac actually doesn't publish it, but you still need to get that accept. So now also with regards to 30-day accounts, which are most likely American Express accounts, the way we take those monthly payments out of the calculation, we just have to show that there's enough assets to cover that, whatever that payment is. So you have an Amex that's running $5,000 a month, and you pay it off every month. You just have enough. You have to have enough assets to cover that payment after we close, minus reserves and stuff like that. So an interesting difference that comes up is with regard to disputed trade lines. So DU tries to assess with the trade lines if an approval is there, no additional documentation is required, which is really good. So if we get an approval, then we are good to go. Now with Freddie Mac, sometimes you'll get like what they call an invalid reading, which then we're going to have to investigate those disputes a little bit more. So it does try to qualify with the disputed trade line, but in the past I've received a lot of those invalid responses. So that was kind of with regard to the credit disputes. What else here? So alimony, the difference between Fannie Mae and Freddie Mac is, alimony is on Fannie Mae is included as a liability or it's subtracted from the income, whereas Freddie Mac, it's treated as a liability only. Okay. So what else? Let's see. And then it just kind of goes into some other regard to without credit score. So if you don't have a credit score, the maximum the maximum loan to value for Fannie Mae is 90%, but with Freddie Mac you can go as high as 95%. So depending on what that is, and Fannie Mae has a hard debt to income ratio of about 40%, whereas Freddie Mac just wants to verify the last 12 months of trade lines, and there's no hard debt to income ratio calculation on that. What else here? I mean, that's probably about enough. There's all kinds of more differences as we go deep into certain kinds of loan products and stuff, but I feel like that's enough of information to give you guys for now. So I wanted to next kind of go into FHA loans versus home ready loans and home possible loans. So those are really designed for the first time home buyer program. So you have an FHA loan that's 96.5% loan to value, 3.5% down, where we can have a home possible or home ready program with 3% down. Those are conventional loans. Now, the neat differences between the two of those is if you qualify, there are income limitations on the home ready and the home possible. Okay, where on the FHA there's not. So that's one big difference. The other big difference is regard to the mortgage insurance calculations. FHA has a 1.75 upfront fee and a 0.85% annual calculation on a monthly basis, every month, whereas the home ready and home possible does not have an upfront fee, and in most cases their annual private mortgage insurance calculation is for home ready it's about 1%, and a home possible it's about 0.75%. So those are some big differences when it comes to monthly payments. So we can always do those calculations as well. So again, the major differences from the income standpoint, there are some limitations based on location and area for the home possible and home ready. But the mortgage insurance is the biggest factor between the two because, let's see here, because because they're just limited by the income there. So sorry about that. And then, so I wanted to also next kind of go into, VA loans. So we do a lot of VA loans, and whether it's a VA purchase, whether it's a refinance, we call them ERLs, which is an interest rate reduction loan. We can do both of those types of loans. So with the VA purchase, the cool thing about it, I've actually done some VA purchase loans with debt to income ratios up in the 60s and 70% range. So it's, if it's a debt to income ratio issue, sometimes we can get those higher ratios done through a VA loan. And we love doing the VA loans. We really specialize in those and love to help our veterans out when they buy homes. So we love to, let's see here. Inga, what's going on, honey? How are you? Ben, what's going on? You guys have any questions about anything? Post them in there. Let me know. So that's what else. So that was just a touching on the VA loans, USDA loans. Those are really in some rural areas. We have I think it's up in some areas of Martin County, north of me, and Port St. Lucie. There's some areas up there. But the cool thing about a USDA loan is they can go 100% of the purchase price, kind of like what a VA loan would be. But there are some income limitations, and it's very specific to areas and stuff like that. So I just want to touch on that. And we also do reverse mortgage loans. So reverse mortgage loans, there's two types. So there's a reverse mortgage loan purchase and a reverse mortgage loan refinance. And so there are some calculations based on age, property value that determine what the loan to value is. But in most of the cases on a purchase, you're probably in the 50% loan to value range. And a refinance, it's going to just determine what the value of the home is, if there's a current balance, a loan amount on the house, and kind of what the age is. So we can calculate that out pretty quickly. I can go into more details about that if you have more questions about that, or you maybe have a parent that is kind of struggling a little bit with some income, and maybe you're supporting them, and you want to give them better quality of life. And we can kind of run some numbers and see how we can change some of their income situations, and get rid of the mortgage payment, and use the house to give them better quality of life. So those are always awesome to do. So that's one of my favorite products to do for somebody that really has that need. So what else? So jumbo loans, talk about briefly. Those are the loans that are over the conforming limits, and we can go up to, 5 million or whatever. There's really kind of no limit. So we have some banking partners that we work with that allow us to go to some higher levels depending on what you're looking to do. But really, basically that's just over a conforming loan limit. So if you're buying $1 million house and you only want to put down 20%, well, you're going to be in the jumbo loan limit. We can also do what they call blended jumbo loans, which is we do a conforming first with a second to offset that jumbo loan. So we can always look at that to see how that looks for you guys. And lastly, I kind of want to talk about some rehab loans that we have available. So there's really two types of rehab loans that I'm going to go into here, and I'll address kind of another one right after. But FHA has one called the 203K. And there's obviously some loan limits that are in play there that are much lower than if it was a Fannie Mae loan. So we have the Fannie Mae loan limits of the $84,350 and the FHA loan limits of $365,000. So depending on what your loan limit is, of what you're trying to do, would determine what kind of product you want to go with. The FHA one has guidelines that are a little bit less stringent, whereas Fannie Mae's guidelines are pretty strict. So depending on your credit, your income, your debt to income ratio situation, you may want to, obviously we'd have to look at both and pick guidelines there. So I just wanted to kind of briefly go over a couple different loan products. I've got a lot of questions lately about some different things. Mainly it was the thanks, Ben, appreciate that, buddy. So I just wanted to kind of just update the loan amounts, because I have been getting a lot of people asking me about that, and we're in the business sometimes and we just assume people know things like that, but they don't. So I wanted to make an announcement about that and just kind of go over just some different loans and products that we have availability to, and I'll continue to kind of update you on some different things as we go along here. So if you guys have any questions about anything, just don't hesitate to reach out to me, private message me, call me. You can call me anytime, 561-373-0987. That's my direct cell phone number. If you want to call in the office, it's 561-316-6800. And I have anyone in my office can help kind of talk with you about things if I'm not available. But call me, text me, private message me. If you're a real estate agent out there and you've got a client that really not sure what they want to do, or what kind of loan product that they need, just have them give us a call. We're happy to run through those options with them. And the ideal situation for a buyer's agent is get us that client as soon as possible, and we put them through our Almost Home program. We get them underwritten, we get them cleared basically to close as a borrower, and then you go out and shop for them. And that's good for up to 4 months without having to really re-pull a credit report. So we just got to get updated asset statements and pay stubs as the months kind of accrue down the road. But it helps you really put a really good offer in. So if you have questions about that, don't hesitate to call me again, 561-373-0987. And I really appreciate you guys today. And if you have any questions about anything down the road, I'm here for you. And have a great day. Talk to you soon.